Every financial bubble stems from widespread conviction. And right now, many people are convinced that artificial intelligence, AI, will change the world. There's no doubt that AI has the potential to do so. But if we rewind 25 years to the middle of 1999, a similar sentiment surrounded the internet. Everyone believed that the internet would revolutionize the world, and it certainly did. However, the internet and e-commerce stocks, which were at the forefront of the TMT bubble of the late 1990s, became mostly worthless shortly afterward. Renowned billionaire investor Howard Marks, co-founder of Oaktree Capital Management, is sounding the alarm on a brewing storm in the stock market. This storm, worth $15 trillion, revolves around the growing enthusiasm for AI, which he suggests mirrors past market bubbles. Marks, known for going against the crowd, emphasizes a key investing principle: be fearful when others are greedy, and greedy when others are fearful, famously quoted by Warren Buffett. Marks now warns that we might be in one of those fearful moments, particularly with the so-called Magnificent Seven stocks. Number 1. The historical precedent: technology bubbles. Bubbles are nothing new in the stock market. They often form when investors get overly excited about a new technology, which leads to inflated stock prices. For instance, in 1929, technology stocks rose dramatically due to excitement over the radio. From 1921 to 1929, shares of Radio Corporation of America (RCA) skyrocketed from $1 to $573 as investors believed radios would transform society. While radios did indeed change lives, RCA stock eventually plummeted by more than 95% when the bubble burst. Another example is the dot-com bubble of the late 1990s. During this period, investors poured money into internet-based companies with the belief that the internet would become integral to daily life. Stocks of companies like Pets.com, Webvan, and Boo.com soared, despite having little to no revenue. In just a few years, these once highly valued companies became worthless as the bubble burst and reality set in. As Mark Twain famously said, "History doesn't repeat itself, but it often rhymes." In 2024, the technology generating the most excitement is artificial intelligence. Number 2. The Magnificent Seven, a reflection of AI enthusiasm. Artificial intelligence, much like the internet in the late 1990s, has the potential to reshape society. Investor enthusiasm has concentrated on a select group of companies known as the Magnificent Seven. These companies include 1. Apple, $2.97 trillion market cap. 2. Microsoft, $3.16 trillion. 3. Alphabet, Google, $2.15 trillion. 4. Amazon, $1.94 trillion. 5. Nvidia, $3.01 trillion. 6. Tesla, $546 billion. 7. Meta, Facebook, $1.27 trillion. These 7 companies have a combined market capitalization of over $15 trillion, which is staggering. To put this in perspective, the total GDP of the European Union in 2022 was $16.7 trillion. The value of these companies is simply mind-blowing. Number 3. The rapid rise in 2023. The stocks of the Magnificent Seven, which include tech giants like Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, have experienced a remarkable surge in 2023. Their average return of over 75% has far outpaced the overall market, with Nvidia, Meta, and Tesla standing out for returns exceeding 100%. This is particularly striking when compared to the S&P 500's 24.2% return over the same period. However, if you remove the contributions of the Magnificent Seven from the equation, the S&P 500's return drops sharply to just 8%, showing how heavily the index's performance depends on these key players. This divergence in performance has raised concerns among analysts and investors about the sustainability of such rapid growth. with some suggesting that these stocks could be overvalued and at risk of forming a bubble. Historically, such concentrated gains in a small group of companies often precede a market correction. To assess whether these stocks are overpriced, one key metric used is the price-to-earnings (PE) ratio, which provides insight into investor sentiment and expectations for future growth. Number 4. Understanding PE ratios, a measure of investor optimism. The PE ratio is calculated by dividing a company's stock price by its earnings per share, EPS. For example, if a stock trades at $20 per share and its EPS is $2, the PE ratio is 10. A high PE ratio typically suggests that investors are optimistic about the company's future growth potential. Let's consider two stocks, A and B. Stock A trades at $20 per share with $1 in earnings per share, giving it a PE ratio of 20. Stock B also trades at $20 per share, but has $2 in earnings per share, giving it a PE ratio of 10. Conventional wisdom might suggest that stock B is a better investment because it has a lower PE ratio. However, if stock A can grow its earnings faster than stock B, it might turn out to be the better investment over time. This is what is known as growing into a higher PE ratio. Number 5. The Magnificent Seven's sky-high PE ratios. The Magnificent Seven stocks are trading at significantly higher PE ratios than the broader market. While the S&P 500's average PE ratio stands at 27, if you exclude these tech titans, the ratio drops to just 15, as highlighted by a report from Capital Group. This stark difference reveals the degree to which investors are betting on the continued dominance and growth of these companies, driven largely by the surge in artificial intelligence (AI) advancements. For instance, NVIDIA, a leading player in AI hardware and software, has seen its PE ratio skyrocket due to high demand for its products that power AI applications. However, the elevated PE ratios across the Magnificent Seven reflect lofty expectations. Investors are essentially pricing in the assumption that AI will unlock massive new revenue streams, fueling rapid earnings growth. If these companies fail to meet these high expectations, either due to slower AI adoption or unforeseen challenges, the current high valuations could lead to significant losses for those who bought at inflated prices. Number 6. The risk of not investing. While it might be tempting to avoid these high-flying stocks, Howard Marks warns that this approach has its own risks. Marks, known for his insightful investment memos, explains that not investing in the Magnificent Seven could mean missing out on significant gains if their growth continues as expected. Marks argues that risk is a two-sided coin. On one hand, you could invest heavily in the Magnificent Seven, expecting rapid earnings growth, only to be disappointed. On the other hand, if you don't invest and these companies continue to outperform, you might be left behind. Number 7. The stock market's dependency on the Magnificent Seven. At the time of writing, the Magnificent Seven account for nearly 30% of the S&P 500's total weighting. This means that the performance of these 7 companies has an outsized impact on the overall market. For example, if the Magnificent Seven generate a 25% return while the rest of the market generates only 7%, the total return of the S&P 500 would be 12%. But what happens if you don't invest in the Magnificent Seven? Let's consider John, an investor who believes the Magnificent Seven stocks are in a bubble and chooses not to invest in them. If the rest of the market generates only 7%, while the Magnificent Seven deliver 25%, John's portfolio would significantly underperform the market. This demonstrates the risks of trying to time the market or avoid certain stocks entirely. The excitement surrounding AI has driven the stock prices of the Magnificent Seven to dizzying heights. While these companies have the potential to grow significantly, they also carry considerable risks, especially if AI fails to live up to expectations. As Howard Marks points out, both investing in and avoiding these stocks comes with risks. Investors should be cautious and aware of the potential for a bubble, but they should also consider the long-term growth potential of AI. Balancing these two perspectives is key to navigating the current market landscape.